silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. So obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will buy. We've seen a lot more central bank buying in the last few years, and many of the indicators are that some central banks are buying gold and not telling anybody about it. They're doing it covertly. The biggest candidate for that is China, where they have they produce about 20% of the world's gold from their own mines. There's also, and I don't have concrete evidence of this, but there's a lot of people who seem to have done the research and got the evidence. There's also large quantities of 400-ounce bars being exported from Switzerland and the UK to China. And these are not the sort of bars which are used at the Shanghai Stock Exchange, which uses 1 ounce, 3 ounce, 100-ounce bars, and then 1 kilogram bars, and they're not the sort of bars which are used in the jewelry industry. So these are the sort of bars which are used by central banks for storage. So there's the internal production of coming from China's own gold mines, perhaps 20% of it going into their reserves, secret reserves. We've potentially got a lot of bars moving to China, which we don't know where they're going, but they're the type of bars which would be held by central banks. And then the last thing we've got is since 2014, China's official reserves, which is basically treasury bonds and gold and special drawing rights, the official reserves have plateaued. Now, that's odd when China's trade surpluses have ever since continued to climb every year. Their trade surplus has been climbing, their current account surplus has been climbing. So for decades before that, as this trade surplus was climbing, the reserves would go up. It wasn't a one-for-one match, but more surplus trade means more money in the central bank. Suddenly, it seems to have plateaued since 2014, which kind of implies they're still potentially building up the reserves, but they're not reporting it. So why are they not reporting it? Because perhaps it would hack off the Americans to know they're buying gold. So they are buying a little bit gold. That's officially reported numbers, but the numbers that they're buying, whilst they're pushing up gold as a percentage of their reserves on the balance sheet, it's still looking like it's relatively small. But in reality, it's probably quite big. And I expect the central banks around the world, which are also building up reserves. I saw an article saying that there's less central banks now reporting their gold purchases than ever before. So implication is there's probably a lot of buying, and that's probably why the gold price has reached an all-time high of 4,000. Well, the high was a bit higher than that, 4,400, but let's call it 4,000 for simplicity. And simply speaking, most central banks are insensitive to the price. They don't care. They're not buying with a plan to sell tomorrow to make a profit. They're buying because they want a plan B, which does not involve the dollar.
China's official foreign exchange reserves have strangely flatlined since 2014, even as the country's trade surplus has surged to all-time highs. Under normal circumstances, rising surpluses increase central bank reserves. Instead, China's numbers stopped growing, an anomaly many analysts interpret as unreported gold accumulation. The motive is straightforward. Announcing large purchases risks geopolitical friction, especially with the United States. Quietly diversifying into gold gives China a plan B outside the dollar-based system. Surveys from the World Gold Council reveal that roughly 3/4 of central banks plan to continue expanding their bullion holdings. Confidence in the dollar is weakening, and gold is the beneficiary.
Yes, I think, Clive, I've seen an article recently as well saying that they did a survey with these central banks. I think 75% of those central banks said that they plan to continue buying gold in the next few years. So that's
Exactly. That's on the World Gold Council's website that they surveyed the central banks, and a large percentage of them said they will increase their gold holdings this year and next year. And of
Yes.
course, from what we know, that has been happening, but a lot of the statistics are very, very out of date. There's a huge lag between, I think we can only see it up till June at the moment. So obviously, not for, some banks have got it right up to date, but the official number for when you add up all the central banks is probably only June, because many central banks don't report, or they report with a long lag.
So, Clive, if we could talk about sentiment. So, okay, so we know that big players are getting involved with gold. We can also see that normal people in countries like China and Asia are also, or in India, are also getting more interested in gold. Would you agree with the statement that in general, masses in the West are still not that involved with this market?
I believe that up until a few weeks ago, maybe only for a week or two, when gold was peaking, there were net purchases in the ETFs. But long and short of it is the number of tons of gold held by the exchange traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers? We don't know.
Market data shows Western investors have been reducing exposure to gold ETFs, even as prices push toward historic highs. Retail money continues to chase tech stocks, leaving gold overlooked. Yet the metal keeps climbing, meaning far larger players are doing the buying: sovereign funds, hedge funds, or undisclosed state actors. Historically, major gold bull markets only peak after Western retail participation returns in force, and we're nowhere close to that phase. Today's momentum is driven almost entirely by institutions repositioning for a systemic reset. If even a sliver of mega-cap tech wealth eventually flows into precious metals, mining stocks could surge dramatically.
Yes, and that would be a bullish thing, right? Because if you look at previous bull markets, usually the bull markets end when the masses in the West do start to get involved.
Maybe end when everybody's involved, and not when they start to get involved. So, in terms of the public at large getting involved, we're still a long, long, long way away from it. If you look at it, just a tiny fraction of NVIDIA's market cap, or Microsoft's market cap, or Apple's market cap, and so on, if that was to find its way into the gold mining sector, NVIDIA's market cap could buy the entire gold mining sector 4 times over if the price was where it is today. So if you can imagine just even a tiny percentage of NVIDIA going to the gold mining sector, those shares would go through the roof. And now we've seen a very large rise in gold mining stocks this year, indicating that there is some interest in gold. But I can tell you factually that many banks who say they've been promoting gold don't actually have any gold in their client portfolios yet, or just starting to put it in. I think it will go in 2026. It's a very long and difficult process when you decide to go from zero in an asset allocation to anything above zero for any asset you like. I know that because I've worked in banks all my life, but just so, people think, oh, it's easy. The bank decides we're going to put 5% in gold and it's done. It doesn't work like that. Let's say the chief investment officer decides that 5% in gold would be a good idea as opposed to 0 or 1% or whatever the number is. There's multiple departments now need to be involved. You need to have the legal and compliance departments involved to make sure that is legal under the rules of the country in which you're operating. You need to have look at the types of clients to find out if there are certain types of clients where that would be not allowed. For example, in Europe, if you take Luxembourg insurance policies, which are, there's many of them investing through Switzerland, the Luxembourg insurance rules do not permit the holding of physical gold. So, these are things which legal and compliance have to look at. You made a decision to do it, but they've got to look at it and say, okay, let's take each client. It may be illegal or not allowed for clients in certain countries. Then you've got to look at how are you going to get your exposure to gold? Do we buy the physical metal? Do we hold gold in account? Do we have an ETF? Do we do it through the miners? Do we make a customized instrument, a structured product to do it? Do we go for a hedge fund? There's lots of different ways of getting that exposure. So that has to be examined by a department who looks at all the possible ways of getting exposure to see how it can be done and how they want to do it. And they're looking at things like liquidity. Can we move enough money in size? You then need the custody department involved to make sure that whatever way you decide to do this, you have the right agreements with your counterparties, because every bank will sub-custody with a third party. It's easy with shares. If you're buying shares, you know where you're going to deposit. It's going to be at the DTC, and it's going to be just the same for Microsoft as if you bought an ETF of gold. But depending on how you're going to do it, you've got to make sure the custody arrangements are correct and properly documented and in place, and the fees are all agreed and everything like that. So you then need to get the investment committee of the bank on side. So it's not just this chief investment officer saying, I want to do it. The whole committee's got to be on side. And you probably have to involve the senior management of the bank as well, because this is a change. You may need to involve the client-facing side to get a feeling for what clients are going to think about this as well. So it's a long process. So probably people have started thinking about putting gold into the portfolios in the middle of the year. They're probably now in a bit of a rush to try and get it agreed as part of the asset allocation for 2026. And I guess in the next few weeks, most banks will be publishing their asset allocation tables of what they're proposing for clients. And I'm expecting many of those to start including gold, because they'll have done the donkey work over the last 6 months as to how they're going to do it.
Major private banks are now exploring adding gold to client portfolios for the first time in years, but the process is slow and bureaucratic. Compliance, legal restrictions, custody arrangements, investment committees, and product design teams must align before even a small allocation becomes official. Some European insurance frameworks still restrict physical holdings entirely. As a result, many institutions won't complete their approvals until late 2025, with allocations expected to appear in 2026. Meanwhile, gold mining shares have already begun recovering from deeply undervalued levels. Institutional capital is preparing to move, but has barely entered the sector. Early investors have the advantage.
I've spent a lot of time in the last few months, going back maybe 6 months, but right up to yesterday as well, examining the potential for various gold mining companies. I'm probably looking at 1 or 2 a day. At least this week I was. And the way I do that is I examine how much gold the company is going to produce. We call it gold equivalent ounces, GEO, because they often produce other things like silver. So if they're producing gold and silver, they'll convert the silver into gold equivalent ounces. So you look at how many gold equivalent ounces are going to produce this year, next year, and making a best estimate of what they'll produce the year after, and so on. You've got to take into account the expected life of the mine as well. Then you've got to put on that number of ounces a gold price. And I typically say how many ounces will be produced in 2027 based on everything we can know. And usually you can find this information on the website. They don't usually say the actual number in 2027, but they talk about whether they're increasing production or decreasing it, or what their expectations. Often you'll get an estimate for next year, but maybe not 27. But I can make a very good estimate of 2027's gold production, how many ounces. I can put a price on it. I take $5,000 as my price for 2027. It could be higher, could be lower. Then I knock off from that so I know number of ounces times the gold price gives me a number. That's their total value of their production. Now I knock off from that what's called the all-in sustaining cost, AISC. Now that's a cost which almost every gold mining company on the planet will publish the all-in sustaining cost. It cost us $2,150 to dig it up. We're selling it for $3,500, whatever. You'll have those two numbers for the last year. So the all-in sustaining cost does change depending on the grades they're digging up and depending on how much bigger the mine is or smaller it is, because if you're bigger, you've got more efficiencies and so forth. But broadly speaking, you take the current number, add a little bit for inflation, maybe 10%, and you can get to an all-in sustaining cost per ounce for 2027. So I knock that off. That gives me the gross profit before other expenses. Then we have to deal with other expenses, which is everything else like taxes, like prospecting costs, like marketing, like management, and so on. So you knock off all those other costs, again adjusted according to the changed number of ounces, and you'll get a net profit. Take the net profit, divide it by the number of shares in existence, and you get a net profit per share, or earnings per share as it's known. And then the last step I've got to do is add a multiple. So most companies trade on what's called a certain multiple of their earnings. And that's called a price earnings ratio. It could be 5 times, 10 times, 15 times, 25 times. Companies like Nvidia and Apple will be trading on more than 30 times their earnings. So that's a bit of a finger in the air, because in one sense, the faster a company is growing, the higher the price earnings ratio tends to be. But gold mines are special because the more you take out of the ground, the less there is to dig up. So they don't justify as high. So even if they're growing by 2027, growing very fast because the gold price is up and everything, it doesn't really justify the 30 or 25 times price earnings ratio that you might see on some of the tech stocks. So I tend to think that probably by then the price earnings ratio could be, if it's growing and it's got further prospects out there, probably 10 times. So I'd take those earnings per share and multiply them by a multiple, which I think is appropriate, typically 10 times, and I get to a price, a future price. Now, I can tell you across the board, I've not yet come across one where the future price ought to be lower than the current price based on those factors. And in many cases, it's many, many multiples of today's price. Now, in some cases, it's 18, 20% higher. And you might, I kind of think it's not really worth the biscuit. Why is it only 18, 20% that you can dig a bit deeper? But in many cases, it's 2, 3, 4 times as high, and sometimes much, much more than that, the present price. So gold shares across the board, I believe, based on my calculations, are massively undervalued. And I think that's because they come from a tremendously undervalued situation a year or two ago to a massively undervalued situation now. I think next year they'll be undervalued, and the year after they'll be fairly valued, and then 4 years from now they'll be overvalued, probably. And that's a bit of speculation. It's not investment advice. But my view is, because we have the higher gold price, those gold mining companies are going to make more profits than are currently being factored into the price. And I think that will do investors very well. I just mentioned another thing about gold shares. When you have a mining company, there's a leveraged effect on the profits when the gold price goes up or down in both directions. So, for example, if you have a gold mining company which is digging gold out of the ground at $2,000 an ounce, that's the cost, the all-in sustaining, and it's selling it for $3,000, its profit is $1,000 an ounce. Okay, now let's suppose that the gold price goes up from $3,000 to $4,000. That's a rise of 33%. But the gold mining company's profit goes up, still digging out at 2,000. It was selling 3, that's 1,000. Now it's selling at 4,000. So the gold mining company's profit doubles from $1,000 an ounce to $2,000 an ounce. So the gold mining company's profit can rise by 100% when the gold price only went up by 33%. So that's your leveraged effect. And the reality here is, I think that most gold mining companies are currently looking at a gold price they're not yet ready to believe it, and the investors aren't ready to believe it. They're looking at a gold price which is back where it was a year and a half ago, $2,500 to $3,000. They're not yet factoring in the extra 1,000 we've had on top of that to 4,000.
Gold miners offer natural leverage to rising bullion prices. A company producing at $2,000 per ounce earns $1,000 when gold is $3,000. But that profit doubles if the metal reaches $4,000. Yet many miners are still priced as though gold were stuck near its 2022 levels. Analysts projecting production through 2027 often find current valuations dramatically underestimate future earnings potential. Even modest price-to-earnings multiples suggest significant upside, with some companies showing several-fold revaluation potential. As gold stabilizes above $4,000, investors are starting to recognize that the sector's profitability is undergoing a structural shift, not a temporary rally.
Silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. Obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will buy 200 million ounces of silver in investment gold this year. When you divide that number out by the population of the planet, you'll find that's one person in 45 or something like that can have 1 ounce. Now, I know half the world probably can't afford anything in silver, but even so, if you think about it, if you have 1 ounce of silver alone, you're already ahead of the other 46 who won't be able to have it, because there just isn't enough. If that 200 million ounces figure, that estimate going into investment demand, is correct. Now, if that figure turns out to be 400 million ounces, because actually there's more than one person of 47 wants to buy an ounce, or that 1 in 47 persons wants to buy 2 ounces, well, where's it going to come from? The mined output is relatively inelastic, so the only place that extra silver can come from is recycled silver. And the only way you get recycled silver is to have a higher price than yesterday.
Yes, great point, Clive. Would there be any other commodities that you would be interested in, maybe like copper, uranium, or anything else?
I haven't done a detailed study on copper yet, but everything I'm hearing from people who have done so says that the copper demand from everything from electrification of cars to data centers and all kinds of other things, the electrification of the world, in fact, is set to be higher in the future than it is at the moment. And it does take a long time to bring on stream new copper supplies. So if what I'm hearing is right, I think I'd be relatively bullish on the long term for the copper, but it's not really in much of a bull market yet. And I think that might just be indicative of the slowing economy, because copper will be much more prone to the ups and downs of the economy. So where I'm sitting on copper is I'm thinking I should start to buy copper miners. I haven't started yet. And I think the way to do it is slowly and gradually over the next 6, 9, 12 months. I don't think there's an urge to rush in, because obviously we do go into a recession. If we go into a recession, it won't be good for commodity companies in general, I think. So, I'm not going to go all in, even if I do start buying. But I think buying gradually will give me a range of prices. Maybe some will be higher than now, some lower. I don't mind, but at least I won't be buying everything at the top of the market.
And what about uranium, Clive?
A couple of years ago, I did a study on the uranium demand is going to go up. A couple of years ago, I did a study of the uranium companies I could find at that time, and I basically turned away in disgust because they were all massively overpriced, in my opinion. So I didn't. Uranium itself, if you know how to store it, probably you're onto a good thing. But getting the shares of the mining companies didn't seem like a good idea a couple of years ago. Maybe I've been proved wrong. I haven't checked the prices, but I haven't gone back to look at them either. But I suspect they haven't got cheaper.
Silver has outpaced gold in the current cycle, driven by both industrial demand and rising investor interest. The Silver Institute estimates investment demand could exceed 200 million ounces this year, a volume too large to satisfy without higher prices or increased recycling. Copper's long-term outlook also appears robust, supported by electrification, data center expansion, AI infrastructure, and EV growth. Though economic softness may temper short-term gains, uranium demand continues to rise as nations return to nuclear power. Yet many mining equities remain priced for perfection. Across commodities, supply constraints and strategic demand are reshaping markets as investors seek assets insulated from monetary instability.